Hey everybody, it's Josh Alexander, and this is your Orange County housing market update for the first week of May. So Thursday we had some technical difficulties, so we're trying again today. I'm glad we did because a lot of data came out on Friday that I wanted to go over. So today we're going to cover three main things. One, how is the California housing market looking in general? Two, I want to talk about some of the things that are a little bit concerning. So the big F words, forbearance, foreclosures, you've probably seen a lot of that in the news recently. And then three, I want to go into and deep dive into the Orange County housing market specifically to kind of talk about what buyers and sellers should be expecting if they're looking to either purchase or sell their home in the next couple months. So let's get into it. So first, let's talk about the California market. So there's a couple of data points I want to point out. There's three of them actually that really start to take a look at the demand and where it's at right now. And there's been a lot of positive signs over the last, let's say, 7 to 10 days that the market is really starting to wake up, especially on the demand side. So let's get into those. So first one I want to go over is this is the amount of showings that you're going to be seeing on homes throughout the year. So the blue line, that's 2019. And you can see basically it starts at the beginning of January. It picks up usually right after the Super Bowl. So second week of April, you start seeing that go up and it continues to rise to where we are now. So that's a typical year that you see that in most of the previous years as well, in terms of how the housing market reacts to a normal housing year. Now, obviously this year has been completely different. So we actually, at the beginning of the year, if you look at the orange line, that's us right now. At the beginning of the year, we actually had a much higher demand for homes, and that we were looking at being probably one of the hottest markets we've had in many, many years before everything basically fell off a cliff when we went into lockdown at the end of March. So if you check out the graph in the orange line, if you look at the end of March, that's when everything tanked. So mid to end of March, everything went down by basically about 50%, even a little bit more than that. But you can see that last week of March, first week of April, it started to recover. And if you look at the last 2 weeks specifically, you see that line going up much quicker now. And that's an indication of how many showings have been happening in the market and how fast it's been going up. It is a good sign for the overall housing market that we're kind of starting to thaw out, I should say, and basically get back not to normal, but to a point where there's a lot of people looking for homes. So just a quick number to look at, since the beginning of May, it's only 9 days ago now, the amount of showings has gone up by 20%. So that's a huge number and a huge bump in showings. And that's just the first data set I want to look at. So the second one, I don't have a graph for this, but I wanted to talk about, and that's the mortgage applications. So mortgage applications for 3 weeks in a row now have actually increased. So that's a good sign on the beginning end, especially for those serious buyers, because most people aren't talking to lenders, getting pre-approvals done if they're not really serious about looking for homes. So over the last 3 weeks, those applications have gone up over 30%. And that's a good indication. Again, demand is really starting to come back online and people are starting to go out, look at homes, and not only going out physically looking at homes like that graph I showed you to begin with, but we're also having a lot of spike in traffic on these online sites like Zillow, Redfin, Realtor.com, those type of things. So if you look at this is actually Zillow specifically. And I think I brought this up last time as well, but just to look at it again, basically compared to even last year, the amount of people looking at homes since the beginning of April has basically went higher than what we were doing last year. So what does that mean? Obviously, people are cooped up in their homes, so they can't physically go out and look for properties until a few weeks ago. And obviously, the restrictions are starting to lift, especially in California. So you're going to see this continue to go up most likely, which is where the numbers are trending. But you can see that there's a lot of pent-up demand. A lot of people are sitting at home right now, looking at these sites, trying to find those properties. And like I said before, they're getting all their documents in line. They're getting those pre-approvals ready to go. And a lot of them are starting to look, actually physically go out and check out properties now. So demand has significantly gone up over the last couple of weeks. So what about supply? So supply has been pretty much even almost the entire year. So it hasn't really been going up or down too significantly. Even when everything at end of March started hitting, supply didn't really tank significantly like you saw the demand. So we had, at the beginning of the year, everything was looking, like I said, to be a very hot seller's market. And we had the demand way up here, supply was down here. When the coronavirus lockdown hit, you had supply drop a little bit, but demand dropped significantly. So that basically put us and almost basically a balanced market. In some cases, a buyer's market on more of the high end properties. But in general, we were in a balanced market for about a week and a half before that demand started to creep up faster than supply. So supply over the last 3 weeks has only gone up by about 4.6%. So it's averaging about 1.5% per week. So we're not really seeing a giant uptick in supply. And why that's important is because demand over the last 3 weeks has gone up 30%. And even more specifically, just the last week alone, demand in Southern California has risen by 23%. So that's huge numbers. That's basically showing that these buyers that are sitting at home are now getting back into the market looking for homes. And that's forcing us back into a seller's market. In most properties under $1 to $1.2 million, we're getting back into a seller's market in pretty much all of Southern California. So that's a good indication that this market is starting to churn along, starting to pick up steam as these phases continue to go through California. As long as we don't have another spike in cases and that type of thing where we have to relock everything down, it looks like everything is trending to continue to go higher and higher and higher for the demand, and supply is finally starting to climb as well. So that's kind of where we are with the Southern California market right now. So why has demand gone up so significantly? And one of the biggest reasons is interest rates. So interest rates 2 weeks ago, they hit an all-time low. So basically you were never able to get a better interest rate than you were 2 weeks ago. This last week, they went up a little bit, but the average weekly rate is still extremely low, and the low 3.2, 3.3% on average. And I just bring up this graph because a lot of people like to see the actual numbers and can't get a grasp until they see dollar-wise what that actually means. So this is just a really easy indication. If you're looking at purchase, let's say a $500,000 home, 2 years ago, interest rates were at 5%. Last year at this time, they're at about 4.2%. And again, this year, they're at about 3.2, 3.3%. So in terms of savings, you can see that just in a single month on a $500,000 home, you're looking at saving $500 a month. So this is taking those buyers that were on the fence that couldn't quite afford a home based on their income and that type of thing. They're pushing them into the market because interest rates are so low right now that it's never been a better time. Your money has never gone further in terms of when you're purchasing your home to lock in that low interest rate. And obviously, as you go up in price, your monthly and yearly and total savings will continue to rise as well. And that's one of the big reasons why that demand is so high right now. So even though we still have restrictions in place, you're not allowed to go freely moving around like you normally do. As those start to loosen up, you're seeing these people starting to come out that have been sitting and were hoping to buy a home this year, but are now starting to get back in the market and say, I've been sitting around long enough. Everything is starting to loosen up a little bit. Let me safely go out and start checking out these homes. You can obviously do it with a lot of 3D virtual tours, that type of thing. If you're looking at homes online, a lot of them have that now. But you're starting to see an uptick on traffic, on people actually physically going out, staying safe, using masks, using hand sanitizer, shoe booties, all that kind of stuff to make sure everybody's protected. But the demand is just so high because those interest rates are so low right now that even if some people are still staying home, there's another 10 people in line out there looking for homes now. So that's kind of where the Southern California market is right now. And obviously, again, we're looking at everything is really starting to uptick. So there's two things that I am still concerned about. And like I said at the beginning, I want to go over. So those are the F words. That's forbearance, foreclosure. So those are the two things you're seeing a lot in the headlines right now. So I want to deep dive a little bit into what those are and how that's going to impact the market short term as well as long term. And so we can kind of get a better idea of how this might really impact a buyer or seller going down the line. So the first one I want to talk about is forbearance. So forbearance, that's basically when you're asking your mortgage lender to, hey, I can't pay. I've got some kind of financial hardship right now. I need to put a pause on my payments on my mortgage. Most mortgage providers are doing anywhere from 3-6 months right now in terms of not paying. So the forbearance issue in general is not what I'm concerned about. It's the certain type of forbearance issue. So the one that I'm concerned about is that those mortgage providers that either aren't providing this right now, or the homeowners that are opting for the balloon payment at the end of the term of whatever their forbearance period is. Because obviously if people are asking for some kind of help when they don't have the financial means to pay their mortgage, at the end of 3 months, they're not going to be able to say, hey, okay, now I've got 3 months of mortgage I need to pay plus this month's of mortgage. So 4 months of mortgage total, it needs to be all due at one time. people that are having financial hardships aren't going to be able to afford that. So that's going to be a significant issue to watch going forward. Now, there has been some things to help mitigate that. For instance, if you look at all the government-backed loans, FHA, VA, all that type of thing, they've come out and basically said that they're not going to require a balloon payment no matter what. So you have the option to go through and say, hey, I can do a balloon payment. If you can afford it, great, do it. And that will help you in the long term. But if you can't, they're going to be working with you to either maybe add a couple extra dollars on your mortgage every month, or put it and redo your mortgage and put it on the back end of your loan, or find some way that's going to work for you to be able to continue paying for this house and staying in your house. So that's a huge help for those people that have those type of mortgages. But the ones that don't, that's where the ones I'm concerned about is if the government doesn't step in, or if these mortgage lenders don't come in and say, hey, we'll help you out, we'll help you get through this. If they don't do that, we're going to have some of those people that can't afford to make that balloon payment. And if the mortgage lender is not giving them any options, then they might have to sell their home. So that's something that we're looking at, and I'm keeping an eye on specifically to try to see where that's going. But it looks like the government is trying to step in, and you'll start seeing more things roll out in the next couple of weeks, most likely to kind of help that back end, so these mortgage lenders can be a little bit more flexible and hopefully help more and more people stay in their homes. So that's one thing to look at. Now, bring this up real quick. So this is based off of yesterday's unemployment report. So almost 15% right now, we're almost 50% unemployment. So obviously that's devastating. That's nothing that the United States wants to see right now. And there's a lot of people suffering, but we do want to bring up, if you're looking at these numbers, that 85% of people still have jobs, and they're still basically going either full-time or part-time and having some sort of income. So that's something that we do want to keep an eye on and not forget that a lot of these people that do have mortgage are able to pay them. And then if you're looking at those people specifically that currently don't have a job because of the shutdowns with coronavirus and everything like that, basically 90% of those people at some point are going to be able to go back to their job. There is going to be a chunk of population, about 10% from what they're finding, that those jobs have disappeared. And so those people are going to have some financial hardships ahead of them, because if they can't find another job quick enough, and if they can't structure their current loan to make sure that they're having some way of paying off that mortgage, that section of the population, you could see some issues with foreclosure. So that's something that we're going to get into now, which is the second point, the foreclosure part of it. So let me put this real fast. So foreclosure. So the big thing with foreclosure, there's a couple categories I'm looking at specifically. They're going to be more impacted than others. So the first one is going to be the ones we just talked about, the people that have lost their jobs and they can't find new jobs and there's no way to pay back that mortgage. That's going to be really one of the only options they're going to have. If their mortgage lender is not working with them, then they're going to have to go through the foreclosure process or sell their home before that. The good thing is there's going to be a lot of equity in most of these people's homes, so they're not selling it for a loss. We'll get into that in a little bit, but there are going to be some people that will have to go through foreclosure because of that. The second group of people in terms of foreclosure that I'm worried about is anyone in the last, let's say, 2 or 3 years that has gone and done like a FHA loan or a low down payment conventional loan, 3%, that type of thing. Those people don't really have a lot of equity built up into their house yet. So if they need to sell their house right away, let's say they bought it last year, they both lost their job, or one of them lost their job, they can't afford it anymore, there's not a lot of equity built up into their property yet, and they can run into issues in terms of selling their home for a loss. It's not a huge section of the population, but it is a part of the population. So that's one of the other areas I'm concerned about. And then the third is going to be anybody that has those second mortgages, third mortgages, people that have those income properties, investment properties, either short-term like Airbnbs, or if they're renting properties out for long-term. Those people right now, a lot of them might not be getting any paychecks coming in from their tenants right now. And if they can't afford their mortgage, that's going to lead to huge issues. So this is going to affect you're going to see this affect a lot more of the vacation rental area. So like Big Bear around this area, Palm Springs, that type of thing. You're going to see a lot more of them have issues because a lot more properties up there, higher percentage of them are usually secondary homes and not the primary residence. So those people can see some problems going in there. Now in Orange County specifically, I mean, there is obviously the renters out there for short-term rentals. 30% of Orange County doesn't even allow short-term rentals anymore. So I mean, there is some concern with short-term rentals in Orange County, but not as significantly as, like I said, the more of the vacation destinations. But it is something to keep an eye out. And so the reason I bring this graph up right here, so this is the percentage of homeowners that have equity built up in their house. So if you look at it, basically anybody under 10% is the chunk of the population that I'm concerned about, because they don't have a lot of equity built in their house. So if something happens and they need to sell their house, they're going to be selling it for a loss and can basically cause further financial hardship for them. Now, 7.3% is not a giant chunk of the population, but it is a chunk of the population that we have to watch out for, because those will be the people that are going to be coming in the most issues coming up over the next couple months with these foreclosures on there. Now in Orange County, those numbers are probably going to be a little bit smaller, and I'll go over that in a second. In California in general as well, probably not going to be as high as 7.3%. But they are a chunk of the population we do have to watch out for. So that being said, foreclosures and people that need to sell their home, that's not an immediate thing. So usually you're going to have at least a 3 to 6 month process before people have to start selling their homes if they go through this foreclosure process. So it's not something that's going to impact our market very heavily this year, but come early next year, there is a possibility that you'll start seeing a little bit more foreclosures on the market. And because the percentages are smaller, I don't see this becoming a giant issue, but it could. It's always hard to really determine what's going to happen, especially right now in the market. And a lot of it's going to have to do with how this coronavirus plays out over the next few months. If we start having more surges again, we have to go back into secondary lockdowns, then we're going to have more issues. And that becomes more and more of a concern as we go forward. If we are able to slowly reopen the economy nationwide, as well as in California, and we can do it slowly and responsibly, then these issues, although there will be people that are going to have financial hardships and have to go through and put their homes up for sale. A lot of them are going to have equity in their home, which means when they sell their house, they're still going to have a profit. They're going to be able to get out and basically get this money and either purchase into the property down the road, rent for a while, whatever they need to do. And they have a chunk of money kind of basically built up through this equity to help them out with that. So although those are concerns, there are a couple other things that are happening right now, as well as just the general condition of California, that will help really alleviate a giant amount of these foreclosures hitting the market next year. And so I wanted to kind of go over that as well, because a lot of people think it's just going to be a massive wave of foreclosures, thousands of them hitting the market at the same time. And that's going to drive the market down and turn it into a buyer's market. And we're going to have another housing crisis like we did in 2008. So although there's always a tiny, tiny possibility that something, again, dramatic can happen where we have to go on lockdown for 6 months or something like that, unless something significant happens in the coronavirus spectrum over the next 6 months, the possibility of that happening is still pretty slim. So this is one of the reasons why I am concerned, but not as concerned, especially for California, is because California has the highest down payment amount, and this kind of goes back to the other slide as well, has the highest down payment amount for any place in the United States. So average down payment is around 20%. So what does this mean? Back to the other slide I showed you before, a lot of people have equity in their homes. So if they need to sell their houses, they're not selling them for a loss. And most likely, if they have equity in their homes, a lot of mortgage lenders are going to try to find a way to make it work, because if they've been making their payments on time and this coronavirus hit, they're able to get if let's say they go and lose their job for a month or two, to get back up and running, get their job back. Most mortgage lenders are going to want to try to make this work. They don't want to go through the foreclosure process because it costs them money as well. But if they can't figure out a way, there could be issues. But again, because the equity in homes across the United States, but also specifically California, is so high, that you're not going to see a giant wave of those hit the market, most likely. Again, this is all assuming we don't have a really bad case of this continuing out through the rest of the year. And that's obviously an assumption that we're making based on the data right now. Now, another reason I'm not as concerned is because there are obviously people that lose their home. But right now, because the demand is so high for homes, there would have to be like thousands and thousands of foreclosures in Southern California to really even budge the market in terms of going from a seller's market to a balanced market and then down to a buyer's market to a deep buyer's market where people are starting to lose equity and home values are starting to go down. So it could happen, but the reasons I don't think that will be the case, there's a few of them. So one, demand. So over the next couple of years, we're basically entering the largest patch of current people looking to purchase homes that we have currently in the market right now. So people between the age of 26 and 33, they're about to hit the market and they're about to get to that first time home buyer stage. So the average person that purchases a home right now for a first time home buyer is 34. So over the next 5 years, we're going to have a lot of this pent up demand of people moving out of their homes, buying their first home. There are going to be a lot of people entering the market for the first time over the next couple of years. So that's going to help keep the demand high. So even if the supply goes up a little bit, you're going to have these numbers with demand increasing most likely even faster. The other thing we're looking at, which is kind of an effect of this lockdown, is that people aren't spending as much money right now. So people are actually staying inside, obviously, but because of that, they're not going out, they're not spending money on as many restaurants, they're not buying things they don't need. Either they can't have it shipped to them because Amazon's not allowing it or some other reason. But people's savings accounts are starting to go up. So it's a positive sign that people are saving more money. Here's another chart as well. Personal savings rate have basically skyrocketed since the beginning of the year because people are spending less money right now. So again, that's going to help these future homeowners and anybody looking to get into the market coming up over the next, let's say, 6 months to a year, to have a little bit more money to put down towards a down payment to be able to purchase this home that they might have been thinking about purchasing for the last year or two. So that's something that we definitely want to keep an eye on, and it looks like that the demand is going to be there unless something happened with interest rates where they skyrocketed past 4.5%, which no one's really predicting at this point because the government wants to help the economy recover. So I don't see interest rates skyrocketing like that for at least till the end of the year. Not skyrocketing at all, but staying pretty flat for the rest of the year, and then maybe possibly going up depending where we are next year, but not anywhere significant enough to really, really take that demand and hamper it down. So really, in terms of interest rates, as well as the amount of people coming on the market looking for a home, that's going to help prop the market up for the foreseeable future. Again, and I keep reiterating this because I want to make sure everybody's clear. This is all assuming that we don't have a giant meltdown again where we have to go back and lock down for another few months, because that will start impacting more and more people financially, and that could impact the amount of demand that we're going to see going into the market. So that's kind of my thoughts about the forbearance and the foreclosure issues. Yes, we're going to see more of them coming up, especially probably starting, let's say, around December, going through maybe midsummer next year. But because the demand is so high, unless something significant happens, there's going to be more than enough demand to keep the supply even going up a little bit into a market where we're either balanced or in a slight seller's market where we're continuing appreciation. Now I want to get into Orange County's market specifically on there. So let me go over here. So Orange County is basically going to follow very similar numbers compared to Southern California with the numbers I went over before. So demand has been going up significantly. Well, supply is starting to increase, but just really hasn't increased anywhere near the amount to make it a concern for any sellers out there in terms of their home values going down. So this is the active listing. So as you can see, it's basically been hovering around 4,000 until about mid-April when it finally started going up. So the other lines in here are previous years, but you can see that it's starting to go up, and it's starting to go up significantly, but not quite as fast as demand. So because of that, if you look at Orange County over the last 3 weeks, supply has increased by about 7.5%. So it's a little bit faster than the average of Southern California, but it's still nowhere near the demand. So if you look at the demand, which is right over here, so demand basically over the last, it was basically up 9% for 2 weeks prior to last week. And then over the last week, it went up 20% in Orange County. So demand in Orange County specifically went up 20% in 1 week. And that's something that's significant because, like I talked about at the beginning, we are basically having those buyers into the market, into the market quickly now. So people are looking for homes. They're basically have already got their pre-approvals, or if not, they're getting those pre-approvals right now. The data is showing that those mortgage applications are continuing to rise. They're out looking for homes now, and pending sales, which is this demand is based off of people putting their homes into escrow, has been going up significantly over the last couple of weeks, but especially this last week. And if we start seeing these trends go another week or two, we're in a very hot seller's market very quickly. And again, this is most price ranges under 1 to 1.2 million. Above that, a lot of those transactions are going to be more tied to the stock market. So as the stock market continues to recover, you'll start seeing more of a trickle up effect. So the lower home prices, we're already in a seller's market right now for them, but you'll start to see that trickle up to the higher and higher end as the economy continues to recover. So as long as we continue a similar trajectory where we are now, you'll start seeing those prices or the demand for those homes above the $1 million mark continue to rise, just not as quickly as those prices below the $1 million mark on there. So the last slide I want to show you before I sign off here. So this is basically the expected market time. So from when you place your home on the market to when it goes into escrow. So right now for homes, anything under 90 days is considered a seller's market. So like I've been talking about, basically any home under $1 million right now in Orange County specifically, we're going to be in a seller's market. So this last week has been completely insane. Talking to a lot of the other agents in my office, we're having people get offers that basically not accepted, even if they're going $10,000, $20,000, $30,000 over fair market value asking price on these properties. So we're at the point now, again, especially under the $1 million range, where you have multiple offers on most properties. You're having that demand. Basically, the demand is exceeding supply significantly, especially if you look at this chart here, that $750,000 and below. 53% of people looking for homes are looking for prices under $750,000, where the inventory is only 37%. So that right there shows you that because we have such a high demand right now, the supply is going to need to increase significantly in order for it to even catch up to be back to a balanced market. And because most buyers are less at risk when they're going out, there's less contact points for them. It's basically easier for buyers to go out and look for homes to stay safe than it is for sellers to put their home on the market, especially if they're living there right now. So if you are a home owner right now, you live at the home. I made a video that I can link to this, link in the comments, but basically there's a lot more contact points you have to have as a seller right now if you're living in your home compared to a buyer. A buyer can go through the property once or twice, and they have contact with the notary once. So you only have about 3 contact points you have to worry about when you're purchasing a house. Or as a seller, you have to worry about photographers going in there, anybody showing the house going in there, inspectors, that type of thing. A lot of people are becoming more cautious, and all these inspectors, photographers are obviously putting into place practices to make sure that the seller stays safe. But because the buying side is so much less risky than the selling side, another reason why you see buyers entering the market faster than the sellers. And that's going to continue. You're not going to see all of a sudden one of these phases of the lockdown get lifted and then a giant amount of sellers pop back into the market. It's going to be a gradual thing as sellers on their individual personalities become more and more comfortable with where everything is with the virus. You're going to see them gradually start putting their homes back on the market. Whereas demand-wise, you're already seeing the spike there. So it's going to be a seller's market going forward. And again, unless something significantly changes where interest rates go so high, where it decreases demand or supply goes up by thousands and thousands and thousands of homes to get it back to a balanced market. And it just doesn't look like that's going to happen at this point. So that's where we are now. If you have any questions whatsoever that I didn't answer here, feel free to comment below and I'll try to answer it as quick as I can. Or you can feel free to write down here, email, call, text, whatever you want. If you have any questions specifically about your situation that you want to answer as well, I'd be happy to help. So other than that, have a great rest of your weekend. Enjoy the nice warm weather we have. Happy Mother's Day to all the mothers out there. And we'll see you again in another week. Bye.